Here's a number that might surprise you. Roughly 60 million Americans have money invested in S&P 500 index funds right now, and many of them couldn't fully explain what the S&P 500 actually is. Today, we're going to change that. Whether you have a 401k, a Roth IRA, or you're just starting to invest, understanding the S&P 500 is one of the most important steps you can take toward building real, lasting wealth. Let's get into it. So, what exactly is the S&P 500? At its core, it's an index, a carefully maintained list of 500 of the largest publicly traded companies in the United States. Think of it as a scoreboard for American big business. It includes household names you interact with every day. Apple, Microsoft, Amazon, J.P. Morgan Chase, Johnson & Johnson. Together, these 500 companies represent roughly 80% of the total value of the entire U.S. stock market. That's an enormous slice of American economic activity captured in a single number. Not just any company can join the S&P 500. There's a strict set of criteria. First, a company must have a market capitalization. That's the total value of all its shares, of at least $14.5 billion. It also has to be a US-based company listed on a major exchange, like the New York Stock Exchange or NASDAQ. It must have reported positive earnings in its most recent quarter, plus positive cumulative earnings over the prior 4 quarters. And it has to be highly liquid, meaning its shares are actively traded. A committee at S&P Dow Jones Indices makes the final call on who gets in and who gets cut. Here's something important about how the S&P 500 actually works. It's market cap weighted. That means bigger companies have a bigger influence on the index's daily moves. For example, Apple and Microsoft together can account for around 13 to 15% of the entire index at any given time. So when Apple has a big day, the whole index tends to move with it. This isn't a flaw, it's a feature that reflects the real economic weight of these companies. But it does mean the index is more concentrated at the top than many people realize. Let's talk about the number that gets investors excited. Historically, since its modern inception in 1957, the S&P 500 has returned approximately 10% per year on average, before adjusting for inflation. After inflation, that figure is closer to 7%. Now, no single year looks like that average. Some years the index is up 25%. Other years, it's down 30%. But over long stretches of time, 10, 20, 30 years, the historical trend has been powerfully upward. Past performance does not guarantee future results, but this historical track record is one reason so many financial professionals reference the S&P 500 as a benchmark. Let's look at the actual data. This chart shows the S&P 500's price history over recent decades. Notice how the line climbs over time despite significant drops along the way. You can see the dot-com crash around 2000 to 2002, the financial crisis of 2008 and 2009, and the sharp COVID drop in early 2020. Each of those felt catastrophic in the moment. But here's the pattern. In each case, the market eventually recovered and went on to set new highs. That doesn't mean it will always recover on any given timeline, but the historical pattern is worth understanding before you make any investment decisions. This bar chart puts the year-by-year volatility in sharp focus. Look at 2008, a loss of about 37%. Then look at 2009, a gain of about 26%. Or 2022, down about 18%, followed by 2023, up about 24%. This is what investing in the stock market actually looks like. It's not smooth or predictable year to year. The key insight is that trying to time which years will be up or down has historically been very difficult, even for professionals. What the data consistently shows is that staying invested across many years tends to smooth out that volatility over time. Here's the practical part. How do you actually invest in the S&P 500? You can't buy the index itself directly. Instead, you buy funds that track it. The most popular options are index funds and ETFs, exchange-traded funds, that mirror the S&P 500's holdings. Tickers like SPY, VOO, and IVV are among the most widely held. VOO, for example, from Vanguard, has an expense ratio of just 0.03%. That means for every $10,000 you invest, you pay just $3 per year in fees. Many 401k plans offer S&P 500 index funds, and you can also buy ETFs through a Roth IRA or regular brokerage account. One of the most powerful strategies for investing in the S&P 500 is called dollar cost averaging. It simply means investing a fixed dollar amount at regular intervals, say $200 every month, regardless of what the market is doing. When prices are down, your $200 buys more shares. When prices are up, it buys fewer. Over time, this approach tends to lower your average cost per share and takes the guesswork out of trying to time the market. The good news? If you're contributing to a 401k automatically from every paycheck, you're already doing this without even thinking about it. Let's make this real with some numbers. If you had invested $10,000 in an S&P 500 index fund 30 years ago and simply left it alone, based on the historical average annual return of roughly 10%, that $10,000 would have grown to approximately $175,000 today. Add regular monthly contributions of $200 per month on top of that initial investment, and the ending balance climbs toward $480,000, based on historical averages. That's the power of compound interest. Your money earning money on top of money, combined with time. This is for illustrative purposes, and past performance does not guarantee future results. Let that number sink in. Starting with just $10,000 and adding $200 a month, that's less than $7 a day. Over 30 years at historical average returns gets you to nearly $500,000. This isn't magic. It's math. It's compound interest doing its job over decades. The key variable that most people underestimate is time. Every year you wait to start costs you more than just 1 year of returns. It costs you all the compounding that would have happened on top of those returns. This is for illustrative purposes only, and actual results will vary. Here's the thing. The S&P 500 historically has rewarded patient investors, but it carries real risk that you need to understand going in. In the short term, losses can be steep. The index dropped roughly 34% in just 5 weeks during the COVID crash of 2020. Unlike a savings account, S&P 500 investments are not FDIC insured, meaning there is no government backstop if values fall. The index is also more concentrated in its top holdings than many people realize, and inflation can meaningfully erode your real purchasing power returns. Understanding these risks is not a reason to avoid investing. It's a reason to invest with a clear strategy and appropriate time horizon. How does the S&P 500 stack up against other common investments? Historically, it has outperformed bonds, savings accounts, and CDs over long time horizons. According to data from Vanguard and Morningstar, actively managed mutual funds have historically underperformed their benchmark index, like the S&P 500, over 10 to 20-year periods in the majority of cases. But the S&P 500 is also more volatile than bonds or cash, which means it may not be appropriate as your only investment, especially as you get closer to retirement. Many financial professionals suggest holding the S&P 500 as part of a diversified portfolio, not as a standalone strategy. Let's bring it all together. The S&P 500 is a market cap weighted index of 500 of the largest U.S. companies, representing about 80% of the U.S. stock market's total value. Historically, it has returned approximately 10% per year on average since 1957, though individual years vary dramatically. You can get exposure through low-cost index funds and ETFs like VOO, SPY, or IVV, available inside your 401k, Roth IRA, or brokerage account. And the data consistently shows that staying invested over long periods tends to produce better outcomes than trying to time the market. Start early, invest consistently, and keep your fees low. This is for educational purposes only. Please consult a licensed financial advisor for guidance specific to your situation. Everything you've heard in this video is for educational purposes only and does not constitute financial advice. The S&P 500 and all investments carry risk, including the possible loss of principal. Past performance does not guarantee future results.